Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Hello, everyone. My name is Thane Stenner. I'm your host of this BNN Bloomberg SmartWealth podcast, which is a monthly podcast that I get the privilege of hosting and interviewing some pioneers and leaders in different industries on various topics every month. So welcome, everybody. I have a very special guest with me here today. His name is Ben Slager. He's a top lawyer here based in Vancouver. And I'll give you a little bit more background on him. But before I do, Ben, welcome. Just want to say a quick hello before I get into your bio.
Delighted to be here, Thane. Looking forward to our discussion.
Likewise. So Ben and I have known each other personally and professionally for about 15 years now, and I can speak to the fact that he's a highly engaging professional and a very astute investor. So I'm really looking forward to interviewing him today and bringing out some of his knowledge and expertise and nuggets for each of you to listen in on. So let me give you a little bit of background on Ben Slager. He's the founding partner and CEO of Mogan Daniels Slager LLP, believed to be Western Canada's leading M&A boutique in the private, small, and mid-cap market space by deal volume. Ben has over 20 years of experience representing clients in the M&A space, private equity, angel, venture capital transactions, and a host of other complex business law matters. The organization Best Lawyers has named Ben Vancouver's Venture Lawyer of the Year in 2022, as well as being top in the category in M&A and venture capital categories over the last number of years. So recognized by his peers and by his industry as being one of the most astute lawyers in the deal space, I would say, in Canada. Ben is also a very active angel investor. He's currently invested in over 20 early stage companies in Canada and the United States with an industrial, health, medical device, and device or med tech and device emphasis. Ben serves on the board and as chair of a couple of these companies and also serves as an informal board advisor to several. Ben is also the co-chair of the Vancouver community of Tiger 21, which is North America's preeminent peer-to-peer learning group for successful active entrepreneurs who are stewarding personal wealth of at least 20 million plus, which now has actually 30 members in Vancouver and over 1,200 members around the world. So Ben's very active in a lot of different things. On the personal front, Ben is proud of saying that he's worked on and invested in some of British Columbia's largest and also some of its smallest transactions. Lastly, Ben is an author of an odd and some might say charming little book about a headless chicken, which is available on Amazon. I think it's had 38 or 49 sales to date, but it's called Flight of the Headless Chicken. Can living from the heart give chickens wings that work? And claims that his greatest accomplishment in life, I would say the greatest M&A transaction he's done in life, has been identifying and securing his wife and life partner, Maureen, who's a sweetheart, in grade 7, and then convincing her to stick with him through all of life's winding roads, even after her many years of due diligence on him. So with that bio in mind, Ben, why don't we get started?
Sounds great. By the way, my mom sent along a few additions to the intro. I don't know if you received those, but she had.
No.
Oh,
please
yes.
do, please do.
Yes, it would probably take another half hour or so, but
Okay.
You got to love your mother out there.
Yeah. Okay. This is good to hear. So you wove that in there. You mentioned her. You did your duty as a son. This is good. So.
Right.
So let's get into the thick of things here. So you're a key trusted advisor to many private companies when it comes to mergers and acquisitions. So I've got a number of questions about this, but we'll start off with what's changing in the current market as far as number of deals, nature of the deal terms that you're seeing, risk appetite, risk allocation, financing, and other covenants today in the deals that you're looking at today?
Okay, so what I'll do is I'll break it down into two categories because MDS, we do work in what I would call conventional private equity, private mid-market, and then venture capital, more tech-oriented early stage. So let's deal with the first category first. In kind of the conventional space, and we get both a healthy buy side and sell side perspective, acting for buyers and sellers as we do. In the conventional space, I would say there's not as much trauma as one might expect looking at structural forces in the market. So, private equity is smart money, and so they find ways to bridge the gaps in valuation or the uncertainty in valuation. So what we're seeing is we're still seeing, I would say, within a margin of 10%, the same number of deals being done. They're taking a little bit longer. Because there's more emphasis on Q of E, quality of earnings assessments. There's more thinking, I think, about external threats like supply chain or great resignation, all these themes that we hear about in the market. And so there's more due diligence being done on people, and especially on key people. Interesting note and related to that, during 2020 and 2021, we did deals, probably 25 deals where buyer and seller did not meet in person. So there's very little due diligence done on key people because you might meet them on a screen for 20 minutes or senior managers longer, but there was no real diligence. Well, that's all coming back, and it's coming back because buyers now have the time they need to do better deals. So they're taking a little bit longer. The gaps in pricing or valuation expectations are being bridged with earnouts. We're seeing many more earnouts, and not just more, but more depth. So whereas we used to see an earnout, it would be sort of for the gravy, maybe 10 or 15% of that bridge between sellers' expectations and buyers' desire to pay. We're now seeing earnouts in the 30 to 40% range. So more significant, we're in uncertain times. Let's go together, buyer and seller, and just see what the world brings. And if the value that you're telling me is there, then we'll share in it. We're also seeing some more vendor takebacks, which is really an earnout in another form, especially if it's what I call profoundly subordinated, which means, if a senior lender comes in on the buy side, the vendor doesn't get paid back their financing until not only are the bank covenants met, the senior secured lenders, but there also has to be a working capital reserve, maybe an earnings multiple above that before the vendor gets paid back. So that's deeply subordinated debt. So we're not seeing the trauma yet. We're seeing, I think, some unique strategic survival techniques to keep deals flowing. That's on the conventional private equity side, the more mature businesses with actual earnings. Now let me take you to the angel world and the venture world. And you mentioned off the top, Thane, that I invest in that space, and I do a lot of work in that space as advisor, investor, board of advisor. So I see that space, and I feel that space wearing multiple hats. So in that space, I probably have on my desk right now three, some people call them recaps, some people call them resets. These are companies that we're looking at either exiting or raising money in, let's say, the $50 to $100 million range in April, May of this year, that are now in the $5 to $10 million range. And so here we're seeing buyers and investors not just more diligent, way more suspicious. We're looking at convertible debt. We're looking at these things called safes, which everybody out there might not know about, but they're SAFE stands for Simple Agreement for Future Equity. It sort of operates like convertible debt. It's a bit more complicated than that. So we're seeing, again, buyers and investors pushing down the risk in terms of time. So they're uncertain times. They don't know what the valuations are. There are these huge gaps between sellers and buyers and investors. And so they say, let's put off the argument, the negotiation, until we know more, until we have a better feel. You know, is the broader tech market going to come back? Are you actually going to generate earnings in the next year, like you say you are? Are you going to get that FDA approval? Remember, all tech's not created equal. There's med tech and there's pharma, and some of those are doing better than, say, the SaaS models. So I'd say the other thing is, and this has surprised me, given our low Canadian dollar, we're not seeing as much US-based acquisition as I would have expected. We're seeing some, because of course that takes 35% edge off of pricing. But I think US buyers, particularly in the earlier stages, still seeing quite robust on the more mature business, the private equity side. But in the early stage companies, I think they are sort of licking their wounds a bit and protecting cash. So lots of changes, lots of creative ways to deal with uncertainty, but still, there's definitely been on the venture and angel side a real compression on valuations, and people that invest in that space will say, "Oh no, we're not in the market." So I'm so glad I'm not in the public markets. But let me tell you, there is a lot of pain in the private venture market space.
Excellent comments. So Ben, before we go on to our next kind of formal question, so what is it that you try to do as a top lawyer to try to bring people together? Like, what are some of the skills that you have intuitively? Because I've observed you professionally and personally, and we'll just talk about the professional for now. But basically, I've seen you do some remarkable things with people at impasses and at challenging points. So how is it that you have that stick handling capability?
Well, let me break that down into two categories. So I'll talk M&A first, and then a lot of what I seem to do has to do with conflict mediation. So and surprise, surprise, sometimes conflict manifests in M&A. So they're not isolated, that's for sure. So in an M&A or financing context, it is, and you will have heard other professionals say this, but you can't emphasize it enough. And there's nothing cute or cliche about it. It's all about alignment. And what does alignment mean? And what is the network involved in alignment? Well, it's alignment. It means, what are your expectations for this business, both on the buy and sell side? Who is going to be key to delivering? So it's talking often when we're doing an M&A deal, the first discussions aren't on price. They're on who's going to be involved in growing this business. Who are the key people? Are the sellers staying on board for how long? What are the expectations? I actually get, because surprise, surprise, many sellers just want to, get on to Zihuatanejo, Mexico after a closing date, and many buyers want them to hang around. So we'll do a page in the term sheet that talks about the expectations personally on the sellers. And so again, we're getting after closing. So we're getting to these matters of alignment. What are the return expectations with private equity? Of course, they have a build and amplify value and then exit within 5 to 10 years. Well, we need to have those discussions. What does that mean for the employees? Sometimes sellers are very protective of their employees. Are they aligned around the vision? So we spend, I think if you can do a lot of the prep work or the pre-work on alignment, it makes for a much more peaceful post-closing transition of the business. And then I'll talk a little bit about the second category, which is, actual direct conflicts between shareholders. Let's say, some shareholders want to sell, some don't, or between management and the board. some of those conflicts can be particularly charged. And of course, the resolution is meaningful for the company and to retain value. With those kinds of conflicts, my approach is centered on alignment, but it's actually trying to get to the root of positions. So in fact, I'm dealing with a situation right now where I have a founder CEO, and it's clear that most of the board members want that CEO to move on, but they also realize that they need the CEO for this transition period. And the CEO has his or her own desires and expectations. And so what I try to do is dig down as deep as I can to find out, okay, what is the fear? What's the motivation? What's the excitement that's driving that decision making? And let's see if we can meet that at the same time, meeting the root drivers, the root motivators on the other side, and then matching expectations and motivations, as opposed to just dealing with what's being said or what's being written at the top level. And so it's really getting down to the root drivers, because I find that the deeper you go with people, the more commonality there is. Boards and management, they want to create value. They want to create value for the whole ecosystem of stakeholders. And so you can get away from all the personal issues, the ego issues, and get down to, okay, how do we create a functional and fair transition and maintain or even amplify value for all the stakeholders? So if you go down to that base level, then that generally produces a strong foundation on which to move forward. So it has to do with, it's easy to be kind of triggered, and people do get triggered in these processes because there's lots of emotion and there's ego and there's lots of money involved. But if you take it back a step, give the situation time to breathe, give the people time to breathe, and then find that common ground and build up, it makes all the difference.
Yeah, it kind of reminds me of the Netflix series where there's a fixer. Her name is Olivia Pope. Olivia Pope. I don't know if you've seen the show, but her number one question to her clients when they come in with a problem or an issue or trying to resolve something, she'd say, "What do you want?"
Yes, exactly.
And she would repeat it. What do you want? She'd push them on it.
Yeah.
And at the end of the day, we're all human beings. We all have our foibles and desires and things that we want to try to see as outcomes. And so you're, in essence, you're actually acting as a facilitator. So you're a leader, right?
Yes. Yeah. Very much so. Well, that's exactly the way I would describe it. And so one variation of that question, I often ask, especially on the sell side with these founders that have built a business, what does the successful exit look like to you? Where are you going to be in 3 years? I don't say 5 years, because people have a hard time thinking that far out. And what are you most fearful of during this process? And it's really interesting, the kinds of responses that you get, and that helps shape the whole process, because now you're getting to the root of what's driving people.
We'll take a quick break here and we'll come back shortly. Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Welcome back, everybody. I'm Thane Stenner. I'm here with special guest Ben Slager. We're going to hop right back into some more questions for this interview. So next question for you then is, what are some of the key mistakes made in M&A or financing projects for private companies that you've seen over the years? Like, what would be the top 2 or 3 that you have seen that are common, but meaningful mistakes? Then I'll ask you the converse side. What have been some of the best practices? Let's start with the mistake side.
Okay, I'll start in the earlier stage company world. So, and this is easy to say, and it's easy to observe. Too many companies were too lean in terms of raising when the harvest was ripe. So I'm dealing with a number of companies that were offered 20 million or 50 million and only wanted to take 5 or 10 because the founders didn't want to give up control. And now what's happening, we're coming in Q1 and 2023, they're going to be looking to raise money, and they're going to be raising at 60% or less of their valuation, and so they're going to lose a lot more. So it's holding things too tight, wanting to keep too much control, not letting others in. So I've seen that in spades. And then this would be a transition, or this would cover both spaces, both the mature and the early stage. And that is not creating healthy redundancies within the firm. So, as people out there will know, if you want to sell your business, and you personally, as a founder or a CEO or whatever your role may be, are integral to that business and to the goodwill in that business, you've just reduced the value on a sale significantly. So you need to create redundancies. Redundancies. I mean, we have redundancy. We have backup plans in our technology. We try to avoid customer concentration risk, but oftentimes founders, because they like control, and control has worked for them. That's how they've built a successful business. They tend not to focus on creating redundancies. A really strong 2IC, someone that's the natural, organic successor in the business. And so I deal with a lot of sellers who would love to sell their business, but the buyers are very leery and very wary, because they know that when that founder leaves, he or she is going to be taking so much of the goodwill and the relationships. And these aren't just customer relationships, employee relationships, going to be taking the culture with them. If you don't have a second in command that can really wave the company's cultural flag and continue to build on that special culture that you have developed over time, then sophisticated buyers will sense that a great deal of the value, or at least a meaningful amount, will be walking out the door on the closing date. And so that is a huge mistake, and it's hard to do. And when you're building a business and growing a business, and businesses that people want to acquire are usually high growth businesses, it's one of those things that you kind of put on the back burner, but it comes back to haunt you. The other thing, which is kind of more practical and measurable, and this is something that I wave a flag on from time to time at conferences and things, is something very simple. It's it has a price tag, but it's quite simple. Audited financial statements. So many of the businesses I deal with, and this is crossing the spectrum, early stage to later stage, have notice to reader or review engagement financials. You would be surprised. So especially actually in the early stage, if you have minimal transactions, and many of these companies do, for another $10,000, you can get audited financial statements. Well, buyers love audited financial statements, and investors love audited financial statements. So to me, it's a no-brainer. It's the best investment you can make. And maybe it's $15,000, but it saves so much more due diligence. It creates trust, and a successful M&A is all about trust creation and preservation. And it actually creates some internal disciplines. Auditors don't just look at your numbers; they actually also recommend systems. And I see that not only in the early stage space, but in the more mature space. Lots of notice to reader financial statements. Whereas now with a higher number of transactions, it might be $20,000 or $30,000 more. But again, on a $50 million deal, you might get a 10x return on that $40,000 or $50,000 that you're paying for audited financials easily. So to me, that's one I haven't heard a lot of people talk about, but it's an easy fix, and the value, I think, is just tremendous. And I'll add one more mistake. It's just because I live in the world of mistakes, and that is on the sell side. Now, and you'll hear stories. There's some good stories out there about sellers who've done it themselves. But I will say that getting an investment bank, an M&A advisor, investment bankers, how they refer to them generally in the US. Here in Canada, we often refer to them as M&A advisors, to generate an auction, to create that competitive tension. I have seen on a $30 million deal that make a $10 million difference just from the competitive tension. So that's right there. That's 30%. And yeah, they they'll take $1 million check, or depending on the success. But again, money really well spent, and M&A advisors, investment bankers have a knack, it's their training, of building trust in an M&A process, and or a financing process, and trust is everything.
So on the best practices,
Audited financial statements, competitive. Yeah.
It's exactly.
Yeah.
I got
No, it's a good question. So some of the best, most successful transactions I've seen have been have resulted from finding the right buyer. So again, this is a sell side perspective. I've got my sell side hat on, and so we've acted for clients who've gone out and sort of locally, maybe just in Canada, maybe picked away at a couple potential strategic buyers in Europe, maybe one or two in the US, but didn't run a full process. And they had, if we were talking multiples of EBITDA, earnings before interest, taxes, depreciation, they got sort of 8 to the 10x, and they were bigger numbers than they ever thought they would get. We encouraged them to hire an investment bank to run a process, and suddenly there's a strategic buyer out there, usually not financial buyers, but a strategic buyer, where this will, this plug-in of this group of assets, this business will, this buyer will get a return of 2 or 3x, and then you multiply that in, and suddenly the target is getting 15x, and so a healthy process leads to a better outcome. But then I was going to get it back into the mistakes world, because I live in that world, but what I've seen as a very healthy and productive approach to investment banking and M&A is, or in bringing in finance and M&A, is to do the self scrub. So you do diligence on yourself. You order a QOV, quality of earnings report, and do that on yourself, and not 4 months before M&A or financing, but a year, or maybe even 2 years. You bring in a consultant. You can actually create an M&A group. You say, in 2 years, I'm looking at M&A. Consists of a lawyer, maybe a company accountant, probably an M&A expert, and probably a key HR consultant, I guess I would call them, and say, what do I need to do to make a more robust business, and to make sure I don't run into those succession problems, to make sure I don't run into due diligence issues or financial issues. And then M&A is not just it's not just a thought at some point in time. It's actually a whole thinking process, and that group becomes your trusted advisor team for the M&A process or the financing process, and the results are dramatically different. And you've gotten in front of all of the due diligence issues that you might have. That strange HR claim, or this workplace accident, or this bug in your technology, or this customer churn, material customer churn. What did that mean for the business? You understand it, you frame it, you get in front of it, and then you lead with your best foot forward with the strength of that team behind you. But if and so those are that dynamic has resulted in some of the best deals I've seen.
Gotcha. So I'm going to rapid fire a few other questions at you, and then I'll slow it down a little bit. So how many deals have you worked on in your career so far as a corporate M&A lawyer?
Yeah, I would say, well, a year ago or so, I was saying 300. So probably, yeah, so probably about 330, 350 deals. That's just M&A, that doesn't include financings, and that doesn't include the stuff that I do personally. So I've probably seen, closer to 500 deals. Well, it doesn't include the deals that haven't happened. So yeah, so I've seen a great many deals across the spectrum, other than in the public sector. I don't deal in the public sector.
Gotcha. And as far as the range of size of transactions, say, what's been your biggest deal that you've worked on? and what was your role, and then typically what would be your smallest deal these days?
Well, and as I say, I like to work on some of BC's smallest and some of its largest deals. So some of Canada's, I guess. So I would say, well, to give you an example, I'm not actually doing the work, but I took this project on for a number of reasons. But there's a little coffee shop in Vancouver. I love the coffee, so we're doing that deal for them. I can't name the shop, but it's a small deal. And then one of the deals I worked on was there are two big. So British Columbia, for those of you out there that aren't from British Columbia, forestry is a big deal here, and two of the big names in forestry for years and years were Canfor and Slocan. And there's still a debate about whether Canfor swallowed up Slocan. It was framed as a merger, but anyways, I worked on that deal. That was probably, I'm going to say 14 years ago, and it was I think it was about $1 billion, the combined entity. And so, but those will be outliers. Typically, our deals and my deals are sort of in the, I would say, $5 million to $300 million range, and beyond that, you start to get into the public sphere. And again, we prepare companies to go public, but we don't take them there.
So a couple other questions around this particular topic. So do you prefer to work for the buy side or the sell side?
Personally, so our firm MDS acts on the spectrum, and so we have 3 or 4 private equity clients. So they're both buy and sell. We have a few large corporates that are acquisitive, and so we're often acting on the buy. But so we certainly do both, and probably in about even numbers. But from and the luxury of getting a little bit more senior in your profession is that you can start to take on projects that give you joy. And I would say I get more joy acting for the sellers because, and especially if the sellers are founders, because you get to be there for the last part of what's often an incredible story, and you get to hear their stories of sacrifice, of the hard work, of the difficult decisions, of the great failures they've had. Many of them have had struggles in other businesses, have learned some hard lessons, and then you're there for the joy of the sale and the culmination of this great journey. And I find a lot of our sellers tend to be these ones that have had their head down for 20 or 30 years. And so they've been really, really focused, and they've never sold a business before. They may have bought or sold a house, but that's, it's a very different dynamic. And so they come to us, and they are the proverbial deer in the headlights. And one of the things that I found, particularly at this stage of my career, a real joy for me, and it gives me a real sense of purpose, is this idea of bringing peace in a really stressful process. And so I like to get there with the founders, shoulder to shoulder, and just kind of get in front of issues and bring as much peace to a very, very stressful process as I can. And then I find that personally very rewarding. So I would say, with apologies to the buyers out there that I act for, I really enjoy the personal, the connection, the intimacy that comes with acting with sellers, who are especially those that are doing it for the first time.
Well said. So maybe discuss, something that's been a pretty unique practice, I think, that you've embedded within your firm is around success fees, like how you structure, your fees. Right. And that's a natural question, entrepreneurs and business owners would always ask, but how do your fees work generally?
Mm-hmm. So I grew up in a large firm here in Vancouver. Now it's not large by New York or Toronto standards, but one of the larger firms, certainly in Western Canada. And I'd mentioned this idea of a fixed fee a few times, including when I was a first year partner, and it was clear it was just falling on deaf ears. Now this was 15 years ago. But what I wanted to do, and it's consistent with this kind of purpose of bringing peace to a stressful process, what I was getting tired of is, doing all this work on a deal, sending out our invoice, and the client's like, "Oh my gosh, I can't believe it," and then having what should be a joyful discussion, having another negotiation around fees, and it's not good for them, it's not good for us in terms of the feeling. And so I wanted to get to a fixed fee on deals, and fixed fees in M&A are very hard to do, and you have to have a model that works for it. And so one of the things I've discovered is you can do fixed fee if you have a high volume of deals. You can also do fixed fee if you have lots and lots of experience, because while you can never predict everything that's going to go wrong, and we can never say we've seen it all in terms of things that can go wrong or stress points. I mean, I've had a deal fall apart 3 days before closing over an 85. This was a $35 million deal over an $85 air permit. I mean, who would have dreamt? Now the deal came back, but an $85 air permit in a factory. So you can never predict the problems that are going to come out of the woodwork. And so fixed fee, that makes fixed fee very hard. But we haven't seen all of it, but we've seen most of it. And so we have a true fixed fee that has a couple of exclusions for tax, which we don't do, and things like that. And the market has really kind of gobbled that up. And we can't take all the credit for it, because we sort of built that on the investment banking model. So investment bankers they'll have a work fee, but generally most of their compensation on deals is percentage based. And so now we're coming up alongside that as a percentage. And there's nothing that private equity likes better, but even sellers like better than certainty in a deal process. And so we are now a line item in terms of our cost. And so they're not afraid to call us in the course of a deal, because they don't hear the timer going on, which means that they ask more questions sooner in the process, which is a virtuous cycle, because it leads to a better process. Now we can get in front of issues, and we have greater certainty that deal will close. So that's been a real joy for me as an entrepreneur, is working on that with my partners and really fine tuning that. And then, because I don't want this to turn into an infomercial, I'll give you one other. And this just goes. It kind of feeds my entrepreneurial spirit. We have what's called a broken deal discount. And so with that, we'll actually give you a discount if the deal doesn't come together. And then if it does come together, you pay a premium, and the discount's, like 50%, and the premium is like 20%. The reason for that is that most deals close. And so we're trying to get entrepreneurial in our, kind of disrupt the field of legal services, which has kind of been wedded to the hourly rate for years and years. And I just, I love speaking the language of entrepreneurs and of business, and it seems to be really resonating with the market.
Excellent answer. So, on a pragmatic issue, I know, you've seen a lot of deals, potential deals in your career. You've worked on a lot, and at this point in your life and career, I think it would be fair to say that you have more people wanting to engage with you in your firm than you have time for. So, how do you practically sift through the opportunities of which engagements to take on or not at this point in your career?
That's a good question. One that our partnership was just discussing last week, because you're right. There's the demands are exceeding supply in terms of our capacity. So I think it actually comes back to alignment. And I don't mean this, again, it's not it's not a whimsical thing, but what will give us joy. So we're now being more selective. It's the beauty of having had some success in the market. We're taking on projects that are meaningful to us, whether it's because the technology in the company is meaningful, or we enjoy working with the people that are driving the company. We're very loyal. So for clients that have been with us and grown up with us over the last 10 years, the MDS has been around for 10 years. We continue to honor them as clients. We are I'm probably not allowed to say this on this cast, but we're not working with assholes anymore, which I quite enjoy being able to apply that filter. We say value focused, values driven in that's our tagline, and we're really looking for ways that we can add value. So I will take on, I took on a complete outlier. It had nothing to do with M&A or finance. It was BC's newest mine, copper gold mine, called Red Chris, and they were doing negotiating with First Nations, the Thane First Nation. It was a ridiculously complex, 30-year small P partnership, and it made no sense for me to take it on. Made no sense for NBS, but I had a little history with the project, and I knew some of the people, and I took it on because I thought I could have a meaningful impact. And it turned out to be I think a 6 or 7 year negotiation, and I don't know, 300 or 400 pages of documents, and it was it was very rewarding. In fact, at the closing dinner for that project, I read my little book, which brought a few chuckles, maybe more than a few. There's also some wine involved, but the book was helpful. And so I think we're trying to be more intentional. We're certainly not taking everything in. We're looking, we're sort of 80% M&A, so and finance, and so we're very selective on the stuff that's not in that space. And we're trying to, we'll act, once in a while we'll take on let's say $1 million acquisition if we're acting for the buyer, and the buyer is in a consolidation play. And because we know that there will be a serial acquirer. So we're trying to think strategically. We're also trying to hire up so that we can scale up, but very, very difficult in this market, as in many businesses and professions, to get good people, especially good people that can work with entrepreneurs who, for those of you that are out there that are entrepreneurs, can be really hard to work with, wonderful to work with, but hard to keep up with.
That's great. We'll take a quick pause there for a minute, and we'll be back shortly. Want to know how Canada's top entrepreneurs think about creating significant wealth? Join me, Thane Stenner, founder of Stenner Wealth Partners at CG Wealth Management and host of the SmartWealth podcast. Download today at iHeartRadio or your favorite podcast platform. Subscribe now. Welcome back, everybody. I'm Thane Stenner. I'm here with Ben Slager, conducting an interview for season 2, our first session. So let's jump right back in. So let's pivot to something else that I know is near and dear to your heart and my heart, and that's Tiger 21. Mm-hmm. I think you've been a co-chair for the Vancouver community, roughly 30 members now. Tiger is a peer-to-peer network throughout the world, but mostly North America, has roughly 1,200 members. So you're a co-chair and you're a key facilitator for that group and spokesperson for that group here in the BC marketplace. So why did you get involved in Tiger 10 years ago, and why are you still involved in Tiger today?
Well, it's a different answer 10 years ago than today, that's for sure. 10 years ago was a very pivotal point in my life when Tiger, that opportunity came across my desk from a really good friend of mine. And at that time I was looking to, so I would have been in my early 40s, actually early 20s. And I was looking to make that leap to the trusted advisor role. And I thought, what better way to become a trusted advisor? And for me, a trusted advisor means you're advising the whole. So it's not just the business, it's the founders. You understand all the inputs and outputs in the founder's life, struggles with their family, personal struggles, their weak spots, blind spots, their gifts, like understanding the whole of the client. And that's what Tiger 21 is. It's a place in a space where you get to explore the whole of these entrepreneurs. And so that was what intrigued me initially, because I thought it would be a natural stepping stone, a natural place of learning for me to evolve. Now, I will tell you this, every year, so I've been sharing with Roxana for over 10 years, which means I should be getting some kind of a diamond pin or something. I'll have to let them know at head office. But every year I do an assessment. Because I have, to your point earlier, too many things on the go. Is Tiger 21, is that sharing experience still pouring into me? Is it still giving me life? And am I still giving it life? Like, am I getting stale? And so every year I do that assessment. And so far, 10 years in a row, I've decided, yes, it's giving me energy. I'm learning lots. And I feel like I'm still adding value. And so that's why I've continued. And I'll be going through that reflection, assessment, reassessment here in December with Maureen. We sort of at the year end do our reflections and what are the things that are life-giving and should we be pouring our limited time and energy into, and what are the things that maybe it's time to move on. But a key reason, and it came up a few days ago when I was talking with a friend who asked me about mentors and in my life, and I'm not one that readily that has what I think of as kind of a conventional mentor, somebody you meet with every 2 weeks who really knows you well and has known you for 15 years, and and they're in the same business maybe or profession, and you're learning from them and following in their shoes, and I have a kind of a constellation of mentors, and I would say my Tiger 21 members have become a key part of that constellation. So I keep learning from them, and I hate to say it, but I keep learning mainly from their mistakes. So, which is kind of a recurring theme in life. You learn so much more from the mistakes, but learning from their stories as well. And it's been a real joy, a real life-giving piece of my life.
So, what would you say? Are kind of the next steps, or in your future, professionally? Personally, at this stage of life, if you just had to look out 5-10 years, or as you say to your entrepreneurs, the next 3 years, why don't we just talk about the next 3 years?
Well, I'm gonna take your first question, because I'm about to sign a new 5-year lease, so I have to stick with the 5 years, otherwise my partners will be saying, wait, what? So it's a complicated question. There are a lot of factors. So one of the factors is, of course, I'm not a lone wolf as much as I'd like to think I am. I have a wife of coming on, it'll be 30 years next year, and so she has her gifts and her future, and has a huge brain and lots of things that she likes to do. So I've got to calibrate for that. We don't walk this journey alone. You've got to think about health. You've got to think about where do you want to live in the world. But I'll share with you some things I'm thinking about. And people around me have always thought that I was going to jump ship and join one of these tech companies that I'm invested in or advisor to. And the thoughts occurred to me from time to time, but I'm probably a little bit, I think one of the beauties of doing what I do is I get to see into lots of different businesses, much like the investment bankers. And I really enjoy that. I enjoy puzzling through, learning new models, connecting dots. And so I don't think that's a risk for me. I'm recently, the last year, become CEO of the firm. And so I'm enjoying building the business building part of that and the energy that comes from that. I do, we talk in Tiger 21 about this evolution from success to significance. And, and that's, for me, it's not an ego driven thing, at least I hope it's not, but I would like to look for ways in the world or in the community, and maybe even a smaller subset than that, of making ways I can really make a difference. And maybe that's in mentoring young people more, young entrepreneurs more. I sometimes think about either formal or informal places in politics, and I've had some early discussions with key people in my life in that regard. I'm enjoying the law firm and the unique value that we're trying to build, not just for our clients, but for the people that work here. I really want this to be an invigorating place for them to work, and that's hard to find in corporate law. And so if we can achieve that, that would be a value. So I guess I'm just looking for other ways that I can pour more into the world and the community around me. And I've also, as I say, I've got to calibrate that with health, considerations and my wife's own ambitions and worthy goals. So it'll be interesting. I'm looking forward to it.
Excellent. And yeah, you've never, to me, since I've known you, you've never leaned away from things. You tend to lean into things and really figure it out. And I think it's wise that you're looking for things that continue to energize you and your wife and your family and your personal and professional pursuits. So I'm going to give you this last opportunity. Any other little pearls of nuggets you want to kind of leave our audience with to finish off this interview today? What would they be, if any?
I think a lot. In fact, I had a breakfast meeting this morning with a fellow who's very successful entrepreneur in his own right. He's early 60s, I would say, and he's come back to help lead a med tech company, a little company with a $10 million valuation. And meanwhile, he sold his other business for hundreds of millions of dollars and doesn't need the money. And so I asked him, I said, why are you doing this? And he said, I really enjoy working with young people, and I feel their energy. I've just got a lot more juice left. I'm learning from them. Yes, they're learning from him, but he's learning from them and feeding off of them. And so, I guess one of the things I think about a lot, especially as I look at building out our law firm and helping some of these companies that I work with build out their teams. And as we hear about structural challenges like the Great Resignation and how do you engage Gen X or Gen Y and Gen Z and Gen X is hard enough. I think I'm part of that generation, but Gen Y and Gen Z. I guess I would encourage people not to get discouraged because I think there are some generalizations and maybe some misperceptions about the inability of this next generation to engage, about how soft they are, how needy they are. There's some of that's true, but I think there is a great energy. I see it in my daughters. I see it in many young people that I work with. And especially if you think globally as opposed to just locally, this next generation of young people, have deep and important energy and ideas. And you look at what's happening in China. I was watching last night the protests, and guess who's on the street protesting where China's going on free speech? It's not the guys like us and older people. It's the young people, and they're agitating for change. And so as I think about what's coming up for me next, as I think about the next generation of entrepreneurs. I was at a conference last week, 17,000 entrepreneurs in Canada, and I don't know how they define that. I suppose a restaurateur could be an entrepreneur, or over 65. So think about 17,000 over 65. So we have a whole generation of new entrepreneurs coming up, and they'll need mentoring and they'll need guidance, but they also have a lot of energy and ideas to give. And so I guess I'm looking to be more engaged with this next generation, and I would encourage others to, there's lots of grit out there in this generation. There's lots of smarts. They're probably better educated and certainly more global thinking than we were coming up. And so, yeah, I'd just like to encourage the older entrepreneurs out there to keep giving in, just like this fellow that I met this morning, who's and I can tell you, it's the gift that keeps on giving. It will invigorate you in really meaningful ways.
Excellent. Well, thank you, Ben, for taking the time out of your very busy schedule. I know how busy you are these days, especially for year end, to kind of share your wisdom and nuggets with our audience. And on behalf of the BNN Bloomberg brand studio team and our SmartWealth podcast, just loved having you on today. And this podcast will actually be released the first week of January. So it'll be kind of a New Year's kick. To actually kick off season 2.
An invigorating kick. Good.
Yeah, absolutely. So it's actually kicking off season 2. So we did first 12 podcasts this last year. So you're actually the first guest of season 2, as they say in Netflix series.
Oh, we got renewed. We got renewed.
Exactly. So thank you once again.
It's a real pleasure. Yeah.
Everybody, please tune in to my next session in January as well for the BNN Bloomberg Smart Wealth podcast. And thanks once again, Ben, for a wonderful session.
The comments expressed in this podcast are the results of work done by Stenner Wealth Partners. They may differ from the opinion of Canaccord Genuity Corp. and should not be considered as representative of Canaccord's beliefs, opinions, or recommendations. All views expressed in this podcast are provided for informational purposes only and do not constitute an offer or solicitation to buy or sell any securities. The statements expressed herein are not intended to provide tax, legal, or financial advice, and under no circumstances should be construed as a solicitation to act as a securities broker or dealer in any jurisdiction. All views are intended for general circulation only and do not have any regard to the specific investment objectives, financial situation, or general needs of any particular person, organization, or institution. Canaccord is a member of the CIPF.